All right, welcome to another FX Street webinar. I'm sure you guys are having a great time with all these guests here today. And I was actually sitting in before, and Rob, I really enjoyed that webinar. And there's a lot of points there that I might even touch on during my webinar. Okay, so let me start with a disclaimer here. Information and opinions contained in this webinar are for educational purposes only and do not constitute trading recommendations. Forex trading involves a substantial risk of loss and may not be suitable for all investors. So hopefully you guys are, have been trading a little bit. I'm not sure if you guys are, some of you have been here a lot, so I'm sure are veterans, and maybe some of you are beginners. But all of you should know, yes, Forex trading is risky, obviously. So let me get started with this webinar. So let me get a little introduction for myself and what we're going to do in this webinar. I've been trading 6 to 7 years, got my CMT 3-4 years ago. I'm a technical trader, and truth be told, I got out of my J curve after blowing up a couple of accounts earlier, before 2010, I should say. I got out of the J curve by 2010, and I've been trading relatively well since then, but as all traders should go through some struggles in the beginning. I manage and contribute to FX.com, which is up for the 2013 FX Street Award for Best Technical Analysis. So vote for me. Here's the link. I'm gonna throw that in the chat there as a shameless promo, a plug there for my site. But okay, so with that said, today we'll be talking about a very specific trading strategy that I've been using for a couple of years now. And it's not the only way I trade, but it is the primary way I trade, and it's the way that I would trade aggressively. There are other tactics and strategies that I dabble in, but I limit my exposure to. But this is going to be the primary way I trade, and I'll talk about that, but I can't cover everything that is needed to help you be a positive trader. And I'm not even saying a great trader, just a positive trader is going to be is a goal for most people, because you guys know the percentages, right? 90-something% fail. So being a positive trader already is you come out of that J curve and you're on your way. You shouldn't go in there thinking you're going to make millions of dollars and right away. So it's a process. It's not just the result that you're looking for. It's a process that you have to make sure you pay attention to and put time and effort into. But I believe what I show can provide a good foundation for a good strategy. This is a pretty simple strategy I'm going to talk about. So I'm going to go through some of the concepts here, look at some charts and examples. Hopefully we'll have some time left to open it up for discussion and look at some live conditions and setups. You can email me for this PowerPoint. And obviously this will be recorded, and Maud has the link for the recordings. And Boyke, the J curve is basically, for any profession really to be, and especially in trading, right? The first part of the J goes down. So you start as a trader, you go through your growing pains, and then you lose. You figure out the first part of your career is to figure out how not to lose. Okay. Because you don't know what you're getting into. Once you hit that bottom of the J curve and start coming back up, and you know how to maintain, you know how to control your losses, how to manage your equity, manage your risks, and you start tweaking more and more into how to be more efficient in your trade management, so that you have better gains and smaller losses, and you keep tweaking that until you get out of the J curve. So yeah, U curve, if you draw the U, you're back to where you started, but the J curve, meaning you put enough effort into it, you'll get out from those growing pains and take off and start being a successful trader. So that's hopefully the route that we can all get into the J curve and get out of the bottom of the J curve. Okay, so let's get started. Okay, and I'm gonna have a lot of text in the beginning, but I'll get to the charts fairly quickly. I know it's kind of boring just to look at text, but I want to go through some concepts. Trend following versus reversion or counter trend. Those are the two types of basic ideas that I see in trading. They're kind of exclusive. They approach trading from a sort of opposite side. When you hear buy low, sell high, buy low, this is sort of, I would say this is kind of amateurish way to think of trading, but it could be legit. This refers to reversal trading, right? When you think the market is too low, you want to buy it and then sell it when it gets back to fair price, or even when it gets to where you think it's too high. So that's one way to think about it. Okay, that's actually not what we're going to talk about. We're going to talk about trend following, which uses the concept of buy high and sell even higher. Okay, or sell low and buy even lower, or exit lower, basically. So this is in anticipation that the market's trend. Okay. And some, like me in the past, have tried to incorporate both. Try to follow the trend, but really buy on a extended retracement back, and against the trend, and trade it back into the trend. That's also a legit strategy. You have your harmonic traders. You have your traders who look for your bats, ABC. Or ABCD corrections and whatnot. Okay, so that's also not what we're going to talk about. We're going to focus on the trend following, and specifically using breakout approach. Again, to continue with that concept of reversal, trend versus reversal, consolidation versus trend. The markets have two types of conditions, right? Consolidation and trend. Okay, if you could just break it down into that, it becomes more simple to look at the market. Sometimes it's kind of hard to, you'll have choppy trends that look like consolidation, but they're trends. You'll have consolidation within which you have trends as well. But so let's talk about in consolidation. If we focus on consolidation, that means there's no direction. The market's oscillating. Okay. And we can spot obvious consolidation patterns in the market, such as ranges, triangles, wedges. I personally prefer ranges. I'll talk about that later. Why? Because triangles can break into a range. Wedge can also resolve into another range. Breakouts of these patterns. For me, I like to see the breakout of a clear consolidation, not just convergence, but breakout from a true resistance, true support. Okay. So consolidation refers to non-direction. Trend means the market is moving. Refer to markets that move clearly from one range of price to another. It can be choppy, but clear ones are very sharp. So sometimes you have consolidation and the market pops up to another range of consolidation, and between those consolidation ranges is the trend. Okay. All right. I'm not going to bore you with too much of this text. If you trade within the consolidation, you're looking to sell on resistance, buy in support. Otherwise, or if you play the breakout, you're looking for that pattern to break. Okay, so we're going to talk about breakout. So breakout and trend following. That's what we're going to focus on. The breakout essentially tries to catch the trend. You got that drift already when the market is done consolidating. Okay. However, this is the main another key concept here. We need to consider the trend of a larger degree that headed into the consolidation. Okay, this consideration can be reflected in the way we play our breakouts into or against a larger trend. So basically, you can be more aggressive when you trade a breakout that's trend following, but if you have a breakout that's going against the previous trend, I would be more conservative and have maybe smaller position size and tighter stops and whatnot. Okay, I'll get into that more eventually. Another consideration is time frame. Okay, let's take a look at maybe some example here. You might be in a trend in the intraday chart. Okay, might be in the context of a consolidation for the week. Let me just jump to the chart. Like for example, here is the euro dollar. You see here is consolidation. If you go into the chart in the 1 hour time frame, for example. Okay. Oh, that's blew it up too large. Okay, here we go. And you start to see a consolidation. You might want to play the support or play the resistance. Okay. And you'll find a trend within this consolidation, right? From here down to here, that's a small trend, especially if you go even smaller into the 15-minute chart. This is why time frame is important, because you need to know what time frame you're trading in. Okay, if you're seeing this type of consolidation and you're trying to trade your support and resistance, you're in your 15-minute time frame, I believe. But if you play the breakout, you're in your 1 hour time frame, okay, or even 4 hour time frame, and this is in the direction of the trend. So this is one example where the breakout is in the direction of the trend, and we'll talk about some targeting in a couple of slides later. But I just wanted to, make sure you guys, when you play breakouts, you can't expect a breakout in the 15-minute chart or 1 hour chart and expect it to give you a target and start looking at the daily chart and give you a target in that daily chart. Let me actually just go back there. When you see this here, you see this trend here. You see a little breakout here, right? You know that you're within this 1 hour chart, and your breakout, you see a previous consolidation area. You have to consider that. You have to consider that this is a breakout in this time frame, and therefore you're not going to your daily chart and going like, okay, here we have a breakout, I'm going to expect it to go all the way down here. No. Okay, you can't, the breakout in the daily chart will have to be from these trend lines here. Alright? Okay, so I'll just move on to to another concept, and this is important. Why do I like the breakout? Okay, you have heard the axiom: don't try to catch a falling knife, don't pick tops or bottoms. I think Jamie Coleman from Forex Live said those who pick bottoms have smelly fingers. But why? Why do people say that? For me, it's a practical matter. If you hop on a trend with momentum, even if the trend is not going to make your target, you can be in the black at early stages of your trade. If you have momentum and you jump on the trend on a breakout, even if that breakout eventually fails, it does afford you a better chance to lock in minimum profit, or at least break even. Okay, when you trade a lot, when you have a lot of trades in there, this is going to be important. Okay, for a specific trade, you might have locked it in profit, and then you might lock in break even, hit your break even, and still go your way. Sure, but in the long run, you want to be able to get these quote-unquote free trades if you could break even and lock in minimum profits. So that's, for me, early stage of your trade management is important for me, and that's why I like the breakout approach. Okay. Now, when you compare it to reversal trades, okay, when you say if the market reverses to 61%, you want to catch it there and try to ride that into your trend, or you want to play a reversal, you play a resistance. for me, I find that these type of trades will take longer to develop for the first stage of your trade. Right? It takes a while. So, even if the reversal does work, it might have to be choppy for a while. You might be in the red for a while. So you're looking at your account. You want to manage your trade. You want to break even. You want to start to lock in profit, but it doesn't let you do that because it's going to be choppy for a while before it goes in your direction. So even though that's a legit strategy, I prefer, and this is just me, I prefer the breakout approach because there's some momentum there, and it affords you earlier chance to lock in profit or break even if your trade doesn't actually end up the way you anticipate it. Okay, so that's something to consider, and I encourage you to try that out yourself. Don't just take my word for it. This is, I guess, 6-7 years of experience has taught me that. But this is really the basis of why I like breakout approach, because it just helps me trade better. It's important. You know yourself as a trader. You know how maybe it's a type of impatience in the way I trade. But that's just how it is. Because when I get in the market, I want to be able to lock it in early. Okay, so that's that. Okay, so let's talk about these channel breakouts and specifically how to spot them. Okay, I like channel breakouts, especially ranging flat ones. I need to see at least 2 rejections to form a trend line. Form that resistance or form that support. And more the better. If you have more resistance, more rejections there, that means the breakout is more significant. Okay. Flat trend lines provide easier planning. Right. This is I talked about this earlier. Flat trend lines, easier planning, and I'll show you guys that in charts in a little bit. Okay. Conventional target using the width of the channel in the direction of the break. All these I'll show you in the. You know what? I'll just jump to some of the examples now, so we can get away from this text-heavy PowerPoint and get into some of the examples I have. Which one did I start with? You know what? Let's just start with this one, Euro Pound. Okay, Euro Pound has been on a tear, and it has been bullish, right? This goes back to January, mid-January. We had a break here. There are other ways, I'm going to talk mostly about price action, but there are other ways to spot the market's consolidation, like your moving averages converging, and they're flat, okay? Your RSI going 70-30, 70-30, okay? Well, I'm going to actually not going to talk too much about these other indicators. I'm just going to focus on price. So maybe if we have time later, we could talk about these other indicators. But here is a breakout. And then here we have some consolidation. We see this level tested a few times, and it has failed. The market has failed to break. Market comes back down, sets some support here a few times again. So this becomes a range. Okay, and notice the market going into this range was bullish, right? Okay, before the breakout, the plan here for the breakout to the upside should be more aggressive than the plan for the breakout to the downside. Okay, that's my opinion there. And we do have a breakout, and the market sets up another range here. Oh, okay, so here's the follow-up with that. It's not exactly a clear range. We have some lower resistance levels here, and then we have this level. This actually was tested only once, and then we have a breakout to the upside. So this is sort of the power of the trend, right? Even though this doesn't have a clear range, the breakout still followed through. Okay, now I can't, if you're going to be more aggressive, I'd rather you be aggressive or prematurely aggressive in the direction of the trend instead of against the trend. Okay, but okay, so that shows you one breakout here and the follow through. I did want to talk about breakout target. A conventional target is to take the width of the range and project it into the direction of the breakout. Now, when you follow a trend, the target isn't that important. It sort of helps you guide your, it helps you with your reward to risk planning, but it doesn't mean that once you hit your target, you immediately exit. That's not always the case. Maybe if it gets to your target and there's some resistance there, you see some other, in this case, other overbought conditions. Okay, this is Rob before has talked about when the market seems like overbought, when the trend looks like it's about to end. You might want to tighten up your stop, right? Bring your stop closer to the market, to the price, so that you can lock in as much as you can from the breakout price action. Okay. Here's another. Okay, so here's the breakout here. You have a test here, another test here, and that resistance fail, and then a breakout, and we have a pullback here, which we're going to get into a little later. But this is another breakout. Now here's the euro dollar, and here's a breakout to the downside against the trend. You see this trend from November has been bullish. You see a market trading sideways. You get some common support. No, they're not always going to be exactly on the pip. Some supports will, you have an area of support, and then that breaks. So for me, this trade would be a conservative one, in that the position size would be smaller than if it were to break to the top side. On top of position size, your trade management will be tighter as well. You want to push your stop to break even, or lock in 15 pips or so as early as you can, because you know that you're going against the trend. Okay. Oh, hi, Mod. Okay. Alright, just had some audio issues there, I guess, but we're good now. Okay, so this here is another example of the market going into sideways consolidation, and there's a breakout to the upside. Okay, so this is late January. Let's jump to the charts and see what happened. Let's see. Okay, so this is late January, and I believe, wait, is this the same period here? Let me just go back. So this is January 20-something when this broke. Okay, let's go to the live chart. Whoop, that's not the live chart. Here we go. January something when it broke. Okay, here. So we're talking about this range here. Okay, and 20-something, and it broke to the upside. And again, I'm talking about, when we talk about target, a conventional target is the width of this range projected in the direction of the breakout, which is here. And that's when I would, maybe you have to look at other things too, like your RSI. I don't have that indicator here, but you can use other indicators. You can use the fact that it's close to 1.36. Maybe then you pull your stop closer. So, and where do you put your stop? Where do you pull up your stop? Well, when the market gives you pivots, those are going to be good places to put your stop. For example, here, the market broke out and actually consolidated again, and here's another breakout that you could probably add position to pyramiding. We're not going to talk about pyramiding that much, but here's an example where you could pyramid and add to your position. As long this came from a breakout and it's in the direction of the trend, so that's an okay for pyramiding. I wouldn't do that if it was against the trend. In any case, you have here when the breakout here comes and then it continues to break out. Okay, now you could put a stop here for break even. Okay? Or you might look at this consolidation, find the central pivot, and this is another concept I'm going to show you. I have in my PowerPoint, but I'll get to it here anyway. You see central pivot, and in my opinion, if the market is going to be bullish in this case, it should stay above the central pivot, which is pretty much 1.3450. Nice even number as well. So maybe you could put your stop even tighter, like here, below 1.3450. As you break out of this channel range, same thing, I guess, and continue to move your stop up. Here you go. You have another consolidation. When that continues, put your stop up here. Boom, here you have another good pivot, put your stop under that, and eventually you might exit here because this market came back and boom, got you out. Okay, so that's one way to try to ride the market, right? When it gives you significant pivots, you take your stop placement and move it up with the trend. Okay, so I covered a couple more concepts there. Central pivot, your breakout targeting, and trade management by moving your trailing stop, manually moving your trailing stop after significant pivots. Okay, let me just jump back to my PowerPoint. Okay, so yep, we covered target, trade management. Talked about being aggressive in the trend following breakout, but conservative in the breakout against the trend. Break even and lock in concepts. I touched upon that, and also pivots help to provide levels to move your stop closer. We talked about that too. Okay, now let's go back there a little and consider the entry again. Backtrack again. We talked about the central pivot, right? Let's go to this range here. Where is the central pivot here? And the central pivot for me is, first of all, should be towards the middle of the range. And it's even better if you do see pivots. You see the support here, resistance here, support here, resistance here. So for this range, when you trade the breakout, you might not have to put your stop under the range. You could put it here, below the central pivot. Now, you consider this is all in the planning phase of your this is before the breakout even occurred. You found that central pivot. Let me just move this chart like that. You found your central pivot. You're saying, okay, a breakout here. I'm gonna put my stop under the central pivot. If it goes down here, the trade doesn't look good anymore. It might still go up because the trend has been up, but I don't want to mess with it. I want to limit my losses and look for the next trade. You can't get caught up sometimes. Once the trade fails, move on to your next trade. Don't get caught up in like, oh, it hit my stop and continue my way. That's gonna just screw you up for planning for other trades. So it's important to stay on point. And I I compare that to, like, a poker player who gets a bad loss, and he starts tilting and making bad calls out of position, and making bad and bad decisions, or a basketball player who misses an open layup and then goes the other way, doesn't play defense, and fouls the other guy, puts the other guy on the free throw line, and it worsens your mistake. So don't let if it's a systematic mistake, let it go. Look for the next trade. Okay, so that's that. But the point here is, what is your reward to risk here? Initially you're looking at this breakout, and your initial target is, in the direction of the breakout. Let's say here is 1.3550, right? So that would be 150 pips. And so it's 150 pips, and your stop placed here around 1.33, let's say 1.3315. Okay, so that would be, well, I should be able to do the math there. 34, 50, that would be 85 pips. So 85 pips, 150 pips. That's pretty good. That's it's not 2 to 1. You're not gonna see these 5 to 1, I don't know, like 7 to 1 type of super attractive reward to risk. I think those are a little bit misleading. I think you got to start with just better than 1 to 1. Okay, because the reason I say that, because there are different stages in your trade. Like if you're following a trend, there are different stages of your trade management, and the first stage is break even. So as soon as you have a little bit of your first pivot, for example, you could start to move your stop up to break even, and at this point your reward to risk is pretty much something to relative to like nothing, to no risk once you lock it in break even, right? So I in these breakout trades, you're not looking for that 5 to 1 reward to risk. You're looking at better than 1 to 1. If it's close to 2 to 1, great. In the first, in the initial trade management part, I rarely see things better than 2 to 1. But it's important to understand that you have to move your stop to break even or lock it in earlier in order to give you a quote-unquote free ride. Because reward to risk, that's sort of a dynamic thing. You can't look at it as a static parameter. It's a very dynamic parameter, and initially you have this 1 to 1, and really to any trade, right? If you look at the market as uncertain and you can't predict the market, you need like a 50-50. So 1 to 1. Once you get to a point that's probably equal to your stop, you might want to already put your pull up your stop. Like if this moves 80 pips, okay, you might already want to move your stop up to lock it in. Okay, so that's what reward to risk is a dynamic thing, not a static parameter. And when you follow the trend, you have more potential reward because you have momentum, right? So don't worry about it if your initial reward to risk is not that attractive. If it's in the trend, you have more potential reward, and if you have good trade management, the chances of that hitting your stop can be lowered. All right. Okay, so that's a little bit about reward to risk. Pullbacks and throwbacks. Okay, I'll take a look at that in a minute. Oh, we talked about central pivot, false breakout. Okay. All right, great. Okay, so we're closing in towards the end of the PowerPoint, and I'll just go straight to these examples here. Pullbacks. Let me find an example. Oh, here we go. We have a pullback situation here in the pound dollar. Okay, and use all your tools that you want to, or that you're good at in identifying trends, such as trend lines. For me, another one is the RSI hitting tagging or breaking below 30 and staying below 60. That's a good sign that the market is maintaining bearish momentum. So this is a trend here. Even I said I wasn't going to talk about RSI, but that's one way I use the RSI to just help me confirm the trend. Okay, so here we go. We have a trend going. It's made some breakouts actually to the downside. It broke out of some trend lines. You don't see it here in this 1 hour time frame, but in the 4 hour time frame you could see it. And here we have sideways action. Support tested 1, 2, 3, and then the fourth time breaks. Okay, and now we have a little bit of pullback. And remember we talked about central pivot. Okay, and this central pivot actually has a nice round number as well, 1.5850. And let's see what happens. I don't remember what happened. Could have gone up and broke it, or if it stayed below the central pivot, that would help maintain the bearish outlook for me. So let's see. Let's go to the live charts. Okay, so this is also January 24/5 pound dollar. Oh no, not this one. Where's my pound dollar chart here that I have? Oh, no, that's not it. Alright, let me just pull that chart up. Okay. 1 hour chart. Towards the end of January. And maybe, this is the one we're talking about. Right, we got our trend line. That's my rough trend line here. And we identified our central pivot. You see, right, resistance, support. There was even support over here, so that's central pivot around 1.5850. Okay, and here's the breakout and the pullback. So the pullback here, I'm looking at this, and again, if you put your stop above, you would have been fine. Okay. So here, after this break here, after this continuation, you might be able to move it down a little more, like your stop placement. Boom. Comes back. Maybe put your stop here now, and boom, you get out. This turned out to be not so great of a trade actually, unless you got out here somehow. Maybe you have a quicker exit. You have your other indicators telling you, this is oversold, and whatnot. You could maybe exit out of these pivots here as they made. This pivot here, boom, boom. This maybe that would have gotten you out. Maybe you got out after your trend line here gets broken. Okay, whatever. So you get the point, right? You get the breakout. They're not always going to give you the greatest reward. Like in this case, you might break even. Maybe you lock in a little bit of profit. Okay, but I wouldn't expect, looking at this market, I wouldn't expect myself to be able to catch this bottom and exit right here. Okay. This is a grind. It's not always, you're not here to catch all the tops and bottoms and make the most efficient trade off of tops and bottoms. Okay, so you have to be able to I guess, understand the trade-off. Okay, now in the short term, the very short term, you have a break here, you have a little consolidation, No. And then you have break to the upside. And this is playing a break against this trend, so I would be conservative, but maybe, half the position I usually do, and make sure I get break even very soon, or lock it in very soon. Maybe this turns out to be a break even, even though we did continue higher. Here's another, range here. And this is interesting because this breakout is in the direction of this trend, but it is against the direction of this trend, right? You have this trend going up, which is a counter trend against this larger trend. So that's going to be, you're going to have to make a call there. Do you want to go straight with, do you want to have full position size? Or do you want to have a small position and add later, maybe? If you get another consolidation here and a break to the downside, maybe that gives you a chance to add a larger position. To me, this is a little bit too quick. I would have missed this, and so forth. So the point here is the pullback. Here's another one. This is a pullback. That's another decision you have to make. Usually when it's against the trend, I want to wait for the pullback. And to be, truth be told, if you're trading this range, it looks like a very small range, and I would respect this rally here. This is bullish trend, so I would be conservative on this break. Okay, and waiting for a pullback could be one way to be conservative. Okay, wait for the pullback, test. Okay, now we continue. We'll short this one, and still short it with a smaller position because of the respect to this little, very short-term, trend that was only a couple, 3 sessions long. Okay, let me get back to this. Some other examples here. I see time is pretty much running out, so I'm going to go through them very quickly. This is dollar. I have a better. Oh, here you go. Dollar CAD. I'm going to talk. Here's the false breakout, and you see, you could visualize some central pivot here. Resistance, support. So when this market broke to the downside, maybe you sold, and then boom, you stopped out. But if you waited for the pullback, maybe you could have saved yourself that small loss. Okay, in the long run, it's not gonna be, each trade is not gonna have such a big impact on your long run performance, but it's gonna be your system. And I say either way, this would have either been a no short or a short with a small loss, and that would be okay. Maybe you consider that, hey, the market looks like it's starting to trend up. You have your moving averages, you have your RSI here, stay above 40, tag 70, break above 70, it's still staying above 40. Okay, so maybe this is a trade that would be against the recent trend, and you want to wait for the pullback. Okay, here these trades are going to be in the direction of the trend, so you might consider have less consideration for the pullback, and also have a slightly more aggressive breakout position size. Excuse me. Okay. Okay, so those are the canned examples. I'll go to the chart here. Look at some live charts. Okay, so where did we? Oh, we looked at the euro dollar. Here's an example here that we're encountering right now, right? We see a pullback here starting February. We have a declining channel. Okay. Oh, okay. I see some questions. Let me just answer these questions real quick. What moving average do I use? You see 600. Yeah, I use the 200 moving average, 150. There's like some Fibonacci numbers in there. Let me just go 5021, 8, I believe. It doesn't really matter for me. For me, the moving averages, the exact period doesn't matter. It's when what happens to them. Like when they converge, that means the market's consolidating. When they expand, that's a good reflection that the market is going in a direction. I mean, you can usually spot the market trending even without the moving averages, but they do kind of help you visualize the trending, the power of the trend better. And also, if all the moving averages start to converge and they get even closer, that's a good sign too that the market is non-directional, and a break from that non-directional period is a good sign that the market is entering into a period of trend. Okay. Difference between pullback, throwback, it's just semantics. Throwback is when the market breaks to the upside and comes back down. That's a throwback. Pullback's the other way, when the market breaks to the downside and comes back up. Doesn't matter, throwback, pullback, same thing. Excuse me if I use pullback when there's a throwback, or vice versa. The concept's the same. Breakout and then comes back to test the breakout range. So here we go again. We have this range here, right? We have somewhat pretty good idea where the support is and where the resistance is. Draw it a little bit like that. Okay, there we go. And I would say the middle central pivot is not that clear here. Okay, but it's around 1.34. I'm going to take that because that's a whole number, a psychological whole number, and I'm going to put the breakout here. Put the stop here. But when you look at this channel, the break of the channel is also a good confirmation or a good signal that the market is breaking to the upside. Now this is a 1 hour chart, and in this 1 hour chart the trend is bearish. Now euro dollar in the 4 hour chart is bullish. Maybe the daily chart is even more bullish, or it's more clearly bullish, but in the 1 hour chart it's been bearish. You have some strong bearish candles here. Okay, so this breakout, again, being conservative, 2 ways to go about it. Small position size. Number 2, wait for the pullback. Okay. Now, small position sizes are always for me when it's against the trend. Pullback, that's sometimes a judgment call. Okay. In this case, let's say you don't have a pullback, and you get this break. You get this break here, 1.3430, and I wrote about this on FX Times as well. The break of 1.3430. Okay, so let's take a look at this reward to risk. Okay, I actually, I like the target here right now, but first stage, the target is here, and you see that it's just above 1.35. So let's call it 1.35. Let's call the target 1.35 actually. Oh, okay, it's right there. So now that's 70 pips. Or let's say you entered a little bit higher. Let's say it's like a 60 pip reward. Okay, you break out. Here you go. You're like, 60 pip reward, and look at this, like pretty much a 45, like say 50 pip risk. So that's just barely better than 1-to-1. Okay, but the point is here is, as soon as the market gets up here, if it gets up here, you can you don't actually have a good chance here to lock it in yet, but you could make your loss a little smaller now. Instead of down here, you could push it up here. Here's another pivot. Now your loss might be a little smaller. The thing is, for me, I wouldn't put my stop here right now. I would give it some more breathing room, and that's always the trade-off. Do you want to give it more breathing room to have a chance to develop? If it's if I can't make it break even or lock it in, I don't, I want to still give it some breathing room. Okay, so here we're waiting for this to develop. If it comes down here, we'll stop out with a loss. If it continues and pushes above 1.35, I'm going to look for some, this central pivot of some consolidation. I don't think this little consolidation has ended yet, but if it does end, I feel like there's a central pivot around this area, 1.3450. So I might move my stop up here, and there I'll be able to lock in the break-even point when the market finally breaks out at 1.35. Then my target would be up into this area, and I'll start to trail it closer and closer back up to that area. Okay, so this channel breakout coming from this range breakout, that's how I would play it in the live market here. Okay, so that's, I think I went over my allotted time, but maybe we just have a couple more minutes if you have any more questions before we wrap it up. And while you think of your questions, let me just go to our final notes on breakout trading. When you look back on your trade, when you assess your trade, channel breakouts will not look that efficient, right? You're looking at this chart, and the market comes up here. Let's say the market comes up here, and then it comes back down, and stops you out, and you get just a little bit of this move, like maybe like this much of that move, right? While this whole move was like from here to here, so maybe you got only a third of that move. It's not going to look efficient. That's something you have to be able to handle if you're going to play the breakout trade. If you look at this trade and be like, oh man, I wish I got it down here and was able to exit up here, that's going to be another strategy, and you're going to find trade-offs. You're going to find negative parameters of that system. So this system, I don't know if this is that negative, but you could say that the negative part of this system is that you're not going to catch the whole trend. You're going to get part of the trend. Okay? And you'll get a lot of losers. I didn't show that many losers. I wish I had, I wish I focused a little more on some of the bad trades. And you do have bad trades. I don't want you to get the wrong idea that you don't, I showed a lot of the winners here, but when you start trading it, you're going to have some of these false breakouts, basically. Okay, you have to manage those false breakouts and keep going. You have, keep going. Cast your net, a wide net, in order to not miss opportunity. In breakout trading, not missing opportunity is slightly more important than avoiding false breakouts. Okay, that's kind of an important concept for me in this system. Okay, and anyway, you can limit the damage that false breakouts do by locking it in, break-even management, and so forth. Okay, all right, so that's it for today, and that's it for me for today. Thank you for your attention. Again, if you want to, the recording is there. Maud will give you the link. You could email me at fan@fxtimes.com for the PowerPoints and to chat about the market or whatnot. So that's it for today. Thanks again for your attention, and that will be the end of my webinar.